It's been a busy week for central banks. The Fed cut rates by 25 basis points, the Bank of England held steady, and Europe remains stuck in uncertainty. Three very different paths, but what do they mean for markets and who stands to win or lose? I'm Johanna Bota, and here to help us break it all down is StoneX's VP Global Head of Dealing Desk, Alex Richards. Welcome, Alex. Good morning.
Good morning.
So let's start with the much anticipated Fed decision. What's your take on it?
Yes, well, Jerome Powell, almost in sort of a note of cautiousness, he sort of said, as we did, we cut by a quarter of a point, which generally I don't think there was any other choice but to do that. He's raised caution. He said there's sort of dangers either side. So we've got dangers to holding and we've got dangers to cut further. So every member of the Fed went for a 25% cut, except for Stephen Mirren, who is also a Trump advisor, who went for the full 50. So at the time, it's almost the Fed, Jerome Powell, trying to put a bit of water on almost the market's excess expectations and cuts, where they really do see further cuts. And I think what we'll probably see at the start of next week, or at least what the markets are expecting, is just that dovish sentiment of further rate cuts to come, starting to push through. We've got quite a few central bankers speaking next week.
So let's go across the pond now, because the Bank of England also had its decision and they actually voted to hold steady. Can you walk us through what that means?
Yes, so again, expectations, due to inflation expectations being high, the markets knew that the rates were going to be held at 4%. What we did see, again, sort of slightly in line with expectations, was a change to the quantitative tightening. So after we had years of quantitative easing, essentially buying government bonds and pushing money into the market, we're now seeing the Bank of England need to sell those bonds. And I think they've now realised, and I think we discussed this on our last talk, that the Bank of England's finally realised that it's partly responsible for quite how high long-term rates are. So almost without trying to make a big deal of it, they've gone, oh, okay, we're going to start, we're going to be buying less bonds now. We're going to reduce that from 100 billion down to 70 billion a year, and they're also going to focus on slightly shorter durations just to balance things out. So in a way, from England, it's sort of business as usual, a bit boring, a bit dull, whereas the US have just gone bold and gone, we're doing it. We're just going to cut and see how things go.
Okay, so we've covered the US, we've covered the UK. What's the story in Europe?
Well, Europe, inflation expectations have pretty much gone away, which has meant that interest rate decisions, and as far as they're going to change, almost it's just not in the news. We're stuck at 2%, and 2%, again, being half of where we are in the UK, almost it's a happy medium. We're happy with that. So the news has moved away from cuts, particularly to actually the weakness of government. So whereas in the US we've just had rate cuts all over the news, all the focus in Europe is just on inaction, weak governments. So almost to sort of paraphrase Dickens and the Tale of Two Cities, we've almost got almost I've never seen this before, where we've got three very different outlooks, almost a tale of three competing economic systems. So we've got the US being bold and lots of growth, but at the same time they're making bold decisions. They're saying we want rate cuts, we want further growth, we want further growth. We've got the worst of times, which is the UK. There's inflation expectations are rising again. There's no sign of a rate cut, and there's not a lot of sign of growth. So that's almost the worst of times. And then Europe's almost slightly different to the UK, in that there could be signs of growth. There's almost uncertainty. It's almost the sort of journalists are trying to sort of poke central bankers and sort of government officials into action, saying, "Come on, let's do something."
Yeah.
So it's almost that sort of excess of wisdom of the central bankers going, "No, everything's okay." And I think people really sort of see that sort of foolishness. Again, to quote Dickens, of actually wanting some action and just not getting it at all.
Yeah. So given these three very different paths, how should investors think about navigating them?
Well, that's it. I mean, in Europe, if it was me, I would be looking at macro factors. So particularly what's going on in Ukraine. And I know almost that's sort of slightly gone into the background. I mean, from a humanitarian perspective or so, it hasn't, but from a sort of economic perspective, it has. But I can really see that being the driver of sort of an upturn in Europe's policies. So there is hope from that side. And I think when we switch to the UK and the US, nothing can sort of get us off this path of rates, really.
So if we think about equities, for example, what do you think are which sector do you think is most likely to benefit from these cuts?
Yes, and this is it. I think when we're sitting in a world where the overriding sort of strength of the dollar to indices, they're being so driven day to day by what's happening. We're almost trying to find what stocks are going to benefit from a rate cut.
Mm-hmm.
So when we're talking about rate cuts, we're talking about retail. First of all, consumers will have more money in their pockets.
Yeah.
Then we're talking about house builders, anything to do with real estate, because again, massive borrowers, so cheaper borrowing, it's just generally a better outlook. And we're also looking at utility companies, because utility companies traditionally, they have fairly sort of steady earnings. So it means if rates are high, there's a good alternative, to getting good rates. So all of a sudden seem less attractive.
Yeah.
But when rates are down at zero, almost those more bond-like returns of utilities suddenly sort of appear a lot more beneficial, I suppose.
And on the flip side, who do you think is going to do badly?
Badly. Well, there's almost two. The obvious ones are sort of banks and insurance. So banks, again, when they're lending, it's less money coming in the door. I know also they're paying out to savers, but it's never as much as they're lending out. That's the nature of the way banks work. But also insurance companies, they sit on huge amounts of money, and also they're looking for steady returns. Mm-hmm. So it's a big downer for banks and insurance companies. I almost sort of put a little split between retail on the consumer side, which is very much on the sort of regular consumer, almost cheap purchases, lower purchases. They're really going to benefit. But high-end consumers, they're actually not too impacted by interest rate decisions, just because, again, if you're not borrowing, if you have money, high interest rates are good from that perspective. But certainly when we look at the list of companies that will benefit versus the list of sectors that will struggle, it's sort of a big one-sided thing that generally companies will benefit from lower interest rates.
Yeah. So just to wrap it up and before we let you go, what should investors be watching out for next?
I would say, again, to split down the three different sectors, I think in the US, it's going to move on from, we know rate cuts are coming. It's almost, the markets have spoken, rate cuts are coming. So we know that. So I think it's almost going to move on from how many rate cuts to
how much.
Well, yes, to how much, and also the knock-on inflation aspect of that, because when we start getting further and further rate cuts, people are going to say, well, is this sustainable, or do they need to rise again? So almost trying to look as far out as possible from a sort of investment perspective. It's inflation in the US. In the UK, I'm really not quite sure, to be honest. It's still the worst time. In some ways, there's that stability, and I think it is, again, inflation. If inflation drops and we can get some further rate cuts, that's certainly going to help.
Fingers crossed.
And then in Europe, again, for me, it's sort of it's wars, and looking for any sign that there's sort of positivity and essentially movement from European governments. Even if that's being stricter on Putin, I think that will really drive markets high.
Alex, thank you so much for your insights, and thank you for watching. For more financial content, don't forget to like and subscribe to our channel.